Starting with your 2026 tax planning, the IRS can turn a $7,411 property tax bill into a $0 federal write-off, and millions of older homeowners do not realize it until they file. Americans were hit with $396.8 billion in property taxes in 2025, and the average single-family bill climbed to $4,427. Yet IRS rules still say those taxes help you only under specific deduction rules. In this video, you'll see why so many retirees think they're getting a break when they are not, which charges count, which ones do not, and the one IRS rule that can wipe out the benefit completely. Let's get into it, starting with the part most people miss. Here is the mystery I want you to stay for. There is one IRS sentence in Topic 501 that can turn a big property tax bill into zero extra federal tax benefit, even if you paid every dollar on time. And in 2026, this gets more dangerous for seniors because the standard deduction is higher, the age-based extra deduction is still there, and many older taxpayers may also qualify for an added $6,000 senior deduction. That means your property tax may never even get a chance to help you. I'm going to show you the exact rule at the end, and once you hear it, the entire 7,411 trap makes sense. IRS Topic 501, IRS 2026 Inflation Adjustments. IRS Senior Deduction. Your tax bill is not your deduction. Point 1 of 4. Your property tax bill is not your deduction. Here's what changed. Property taxes keep rising, especially in high-tax areas, and many homeowners now see bills that feel shocking on paper. Atom says the average single-family tax bill in 2025 was $4,427 nationwide, while states in the Northeast posted much higher average bills, including more than $7,700 in New York and nearly $7,900 in Massachusetts. Here's what it means for you. A high bill does not mean you get a high federal write-off. The IRS does not reward you just because your county charged you more. The IRS says property taxes are generally deducted only as an itemized deduction on Schedule A. That is the first trap. Many retirees hear property tax deduction and assume the full bill lowers taxable income. That is not how it works. If you take the standard deduction instead of itemizing, that property tax bill usually gives you no separate federal deduction at all. Stop! This is the part that surprises most people. A property tax payment and a property tax deduction are not the same thing. Think about a retiree who pays $7,411 in property taxes, has no mortgage, gives a little to charity, and takes the standard deduction. That homeowner may feel squeezed all year and still get zero extra federal tax value from that property tax line by itself. Here's what you must do. Stop looking only at the bill and start looking at the deduction method. Ask one question first. Am I itemizing this year, or am I taking the standard deduction? If you do not answer that question first, you can fool yourself into thinking the IRS is giving relief when it is not. And this ties directly to that mystery rule I mentioned, because that rule decides whether your property tax ever counts at all. So what does this mean for you? It means paying a large property tax bill does not automatically give you a federal tax break. IRS Topic 501. IRS Homeowners Tax Benefits. Some charges on your bill do not count. Point 2 of 4. Not every charge on your property tax statement is deductible. Here's what changed. Counties and local governments often bundle different charges together, and many homeowners assume the whole amount is deductible. The IRS says deductible real property taxes are generally taxes levied for the general public welfare and charged uniformly at a like rate. That sounds technical, so here is the simple version. The charge usually must be a real tax that applies broadly, not a special fee tied to a specific benefit for your property. Here's what it means for you. If your annual statement includes special assessments, service fees, or local improvement charges, the whole bill may not count. The IRS specifically says some items are not deductible on Schedule A, including homeowner association fees, water charges, sewer charges, trash collection charges, transfer taxes, and taxes for local benefits, unless they are for maintenance, repair, or interest connected to that benefit. Write this down. If the charge improves your specific property, it is often not your federal deduction. If the county added a sewer hookup assessment, a sidewalk assessment, a drainage project charge, or some special district fee, That may not belong in the deduction bucket the way many people think. Here's what you must do. Pull out your latest property tax bill and read the breakdown, not just the total. If you pay through escrow, compare the mortgage escrow statement to the county tax notice. If something is unclear, call the tax office or ask a qualified preparer exactly which line is regular property tax and which line is a fee or special assessment. This matters because the trap is not only that some people fail to itemize, the trap is also that some people think the full amount qualifies when only part of it does. And yes, this connects back to that IRS sentence I'm going to reveal, because even a valid property tax amount helps only if you clear that bigger test. So what does this mean for you? It means you should never assume the total on your bill is the total the IRS will let you deduct. IRS Topic 503. The 2026 standard deduction makes this harder for seniors. Point 304. The 2026 standard deduction is high enough to wipe out the value of itemizing for many retirees. Here's what changed. For tax year 2026, the IRS says the standard deduction rises to $16,100 for single filers and $32,200 for married couples filing jointly. On top of that, older taxpayers still get an additional standard deduction for age, and IRS guidance says many people age 65 and older may also qualify for an extra $6,000 senior deduction from 2025 through 2028, subject to income limits. Here's what it means for you. The bar you must beat before itemizing can be much higher than many seniors realize. A single older homeowner may be looking at a standard deduction that is already far above the base amount once the age add-on is included, and an eligible senior may add another $6,000. A married couple where both spouses qualify can push that deduction level dramatically higher. IRS 2026 inflation adjustments. Let me make that plain. If you are married, both age 65 or older, and eligible for the enhanced senior deduction, your combined standard type deductions can reach levels that many retired homeowners will never beat with property taxes alone. So if you paid $7,411 in property tax, that number may sound huge, but it may still be nowhere near enough to justify itemizing once you compare it to your standard deduction, plus age-related and senior-related deductions. And if you have no mortgage interest because the house is paid off, the odds of itemizing drop even more. Rhetorical question, do you see the trap now? The higher your standard deduction goes, the easier it is for your property tax deduction to disappear in practice. Here's what you must do. Add up all likely itemized deductions together, not property tax by itself. That means property tax, state income tax or sales tax, mortgage interest, charitable giving, and medical expenses that actually qualify. Then compare that total to your standard deduction. If the itemized number is lower, the property tax did not help the way you thought. And that brings us even closer to that $0 rule at the end. So what does this mean for you? It means a rising standard deduction can quietly erase the federal benefit of your property tax bill. IRS Topic 501. IRS 2026 Inflation Adjustments, IRS Senior Deduction. The SALT rule still doesn't save you automatically. Point 4 of 4. A bigger SALT limit does not automatically mean a bigger tax break. Here's what changed. IRS Publication 17 and the 2025 Schedule A instructions say the overall deduction limit for state and local income, sales, and property taxes increased to $40,000 for most filers, with reductions above certain income levels, but not below $10,000. A lot of homeowners hear that and think, great, my property taxes are finally deductible again. But here's what it means for you. That higher cap matters only after two other things happen first. First, the charge must actually be deductible under IRS rules. Second, your total itemized deductions must beat your standard deduction. If those two steps do not happen, the higher SALT cap changes nothing for you. IRS Publication 17. IRS Schedule A Instructions Stop. This connects directly to the rule I warned you about. The real trap for many retirees is not hitting the cap. The real trap is never getting close enough for the cap to matter. A retired homeowner with a paid-off house, moderate charitable giving, and ordinary medical costs may have valid property taxes, may be below the income phase-out, and may still get no extra federal benefit because the standard deduction is simply better. That is why so many people misunderstand this issue. They focus on the headline cap and ignore the comparison test. Here's what you must do. Before you assume your 2026 planning includes a big IRS break for property taxes, run one simple comparison. Put your likely itemized deductions on one side. Put your standard deduction on the other side. If the standard deduction wins, the property tax benefit is mostly a paper illusion. And if your bill contains non-deductible charges, the gap can be even bigger. This is exactly why the mystery rule matters so much, because it is the final gatekeeper. So what does this mean for you? It means the SALT rules do not help unless your total deductible amounts are high enough to justify itemizing in the first place. Now let's close the loop. The mystery rule is this IRS sentence from topic 501. You should itemize deductions on Schedule A if the total amount of your allowable itemized deductions is greater than your standard deduction. That is the sentence that changes everything. And the mystery number is not really $7,411. The mystery number is 0. Because if your allowable itemized deductions do not beat your standard deduction, that $7,411 property tax bill can produce 0 extra federal tax benefit. That is the trap. Not because the tax was fake, not because the bill was small, but because the deduction method made it worthless on your federal return. This is the part I want you to screenshot or write down, because this affects your check directly. Before you count any property tax savings, compare your total allowable itemized deductions against your standard deduction. If itemizing does not win, the IRS rule wins. So what does this mean for you? It means the only property tax deduction that matters is the one that survives the standard deduction test. Before you go, I have one question for you. Has your property tax bill gone up faster than your Social Security increase? Tell me yes or no in the comments. I read every single one, because the next video I'm releasing covers how the new senior deduction can quietly change what retirees owe the IRS in 2026. And if you're not subscribed, you will miss it. Hit subscribe now so YouTube notifies you the moment it goes live. Also, go back to 2:30 in this video. There is one detail I mentioned that most people miss on first watch. Now that you know the full picture, it will hit differently.